Hello, students. Welcome to week 2 of the Accounting Principles class. I'm praying for you this week as we go through this course. Besides watching this overview, please be sure to check out the devotional each week and for this week as well. And be sure to read the assigned readings for the course text. Okay, let's take a look at week 2. This week we're defining what an accounts receivable and notes receivable are, what they look like in our accounting system and what they are. We're also understanding what the allowance method is for collecting what we term uncollectible accounts. Any business has customers, surprise, surprise, who will not pay, and so that lack of payment has to be documented and accounted for in our system. Now, we're also learning how to do some quick calculations on the notes receivable assets. That's how do we track money owed to us through loans that we give into others. Those are the notes receivables. We're going to look at that. And finally, we'll learn about some alternative means to collect the money owed to the company. All right, so first, let's take a look at the accounts receivable. Another name for accounts receivable is AR, so A/R or AR if you hear that term floating around. ARs are short-term agreements by a business with its customers. When a customer buys a product from a business, buys a product from you, for example, the business sends an invoice to the customer for items or services that were purchased. The invoice becomes an accounts receivable asset. It's a future cash owed to the business by a customer, so it's an asset. Usually the invoice from the business to the customer identifies what we call net terms of the payment, meaning the business expects to be paid in full from the customer per these terms. Often the terms are expressed in days. So an invoice that has net terms of 10 means the business expects the customer will pay within 10 days. Now, I strongly encourage you as you go into the business world, negotiate these terms before you make a sale to the customer, certainly before you ship it to the customer or before you deliver a service. The businesses also track the amount of AR as a percentage of their total assets. Now, the idea is to understand how much of a business's total assets are tied up in commitments from customers who have not yet paid. The higher the AR percent, the more risk there is of the business not getting paid. This chart shows the typical AR percentages by industries because the AR percentages are different based on the kinds of services and products that you deliver. Now you can see that ad agencies, for example, have a lot of their assets tied up with the accounts receivable, about 20%. Now look at the airlines, only about 4%. That's because, you as a customer, when you book a flight, you have to pay right away. Usually with a credit card, you have to pay those airlines right away. So not a lot of accounts receivable stacking up there. Let's take a look at the notes receivable for a moment. Now, a note is an asset because it's money owed to the business by another person or another person. My advice here, don't do it. Unless you're a bank, just don't loan money to other people or other businesses. If a supplier or a customer needs cash, don't put your cash at risk by giving it to them. Have them go to their bank or private equity fund to get the cash. Okay, uh, in any business where customers owe us money, we need to estimate how much of that money is owed to us, is at risk for non-payment from our customer. Now, we need to estimate how much is uncollectible. And yes, again, sometimes, surprise, surprise, our customers don't pay us. Now, the first method of estimating the uncollectible account is to take a percent of the net sales, for the time period that you're studying, and then set that aside in the uncollectible account balance as an expense on the income statement. So the percentage amount is based on the historical figure of the rate people are not paying you. Now, the second method of estimating uncollectible accounts is to take a percent of the accounts receivable and set that aside in the balance sheet in an uncollectible account. Again, the percent applied to the AR level is usually based on some history of understanding how often people miss payments to you. Now, by the way, this is the method that we use in our staffing firm where I work to estimate uncollectible accounts. It's straightforward and meaningful to us, so that's what we use. Notice though, the first method hits the income statement, and the second method hits the balance sheet. Now, there are advantages and disadvantages to each of those methods, but be sure to read about them in the course text. If your business does have notes receivable, and hopefully you don't, but if you do, there are several ways to estimate the notes receivable account on the balance sheet, as shown from this list here. So, maturity date, interest, that sort of thing. Take all those into account when you're estimating the notes receivable. Managing your accounts receivable account is really important. Think about it. The AR account holds the value of the money that you expect to eventually be deposited into your cash account, your checking account, for example, for your business. If you don't manage the accounts receivable account, you could show you could show great profit on your income statement, for example, but have no cash in the bank. So, which is not good. So you could look profitable, but you got no cash. And no cash means you can't pay people, can't pay suppliers, can't invest, can't grow, will go bankrupt. All right. So there are two ways to measure the effect of the accounts receivable account, the AR account. The way to measure the effect of the AR account on the business is the receivables turnover method, and the second method is the days sales uncollected. Because the estimating the uncollectible accounts is a negative hit to the business, it's really easy to tempted to be unethical in doing this. And you do that by decreasing the percent of what you think is going to be uncollectible. And so you tend to overstate your accounts receivable. You overstate your notes receivable as well. A smaller percent means a smaller uncollectible account, which artificially, like I said, props up those assets, for instance, on the balance sheet. It's not a faithful representation of the true state of affairs. So don't be convinced by unscrupulous managers that you might work for in the future to fudge those uncollectible accounts. Be honest about them. When we talk about receivables, we have to talk about receivables turnover. There's two pieces of information to measure this particular ratio. Um, for any time period, gather up the net sales and the average accounts receivable. Divide the net sales by the average accounts receivable answers the question, how many times did the company collect its accounts receivable during the time period? The higher the number, the better off the cash position. So, by the way, hint, you may want to know this, might be on a quiz or an assignment coming up. You have different financing options because managing the conversion from accounts receivable to cash is so important to the cash flow of the business. There are some options that you have to be able to extract and pull cash out even before you get it to help you out. So three of the options are listed here. Now, in our business, we use a form of factoring when we need to in order to prop up our cash accounts. We do this through a line of credit when we need to. But there are businesses you can go to that will help you what's called factor your invoices. So remember, read about those in the course text. Okay, listen, that's it for now. Remember to get your discussion questions and quizzes and assignments in on time. And remember, God is on his throne. He's always been there. He's always going to be. Have a great week.